In today's episode of the Daily Brief, I'll talk about two interesting stories. I first talk about Sri Lanka's shot at redemption and how the recent news on restructuring of debt can make things easy for them. I then discuss some interesting details about India's fertilizer industry and how they want to fight import reliance. Welcome to the Daily Brief Show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to the news channels. I'm your host, Kashish Kapoor. Today is Friday, 29th. You can find us on Spotify, Apple Podcast, or wherever you consume your podcast. The Daily Brief is also available in Hindi, and if you like reading instead of watching or listening, you can sign up for our no spam newsletter for a quick rundown. All the links are in the comments. Let's start with the first story. Sri Lanka's shot at redemption. Will debt restructuring be enough? Moody's, the credit rating agency, has hinted that they might actually upgrade Sri Lanka's credit rating. That's kind of a big deal. In case you've forgotten, not very long ago, Sri Lanka was in such a deep economic mess that it couldn't even pay its debts. So here's what's happening. Sri Lanka is trying to fix things by swapping its old troublesome debt with new friendlier debt. And Moody's has given the new debt a better provisional rating. It's still not great, it's deep in the junk category, but it's definitely better than before. This optimism around debt restructuring is also why Sri Lanka's bond have turned in a surprise performer this year, delivering a whopping 29% returns. For investors, it's a sign that market believes Sri Lanka might just be able to stabilize its economy, at least for now. But how did Sri Lanka even get into this mess? Let's rewind to 2009 when the country's 25-year-long civil war ended. The cost of the war? A staggering $200 billion, 5 times the size of Sri Lanka's entire economy back then. After the war, the country needed to rebuild, but it got too ambitious. Instead of focusing on increasing exports or boosting trade, it tried producing all the goods it needed for its domestic market. Now that might sound patriotic, but here's the problem. It failed. Instead, it kept digging itself into a hole. Sri Lankan exports stayed flat around $10 million a year while imports shot up to $18 billion. Every year, Sri Lanka was importing roughly $8 billion more than it exported. And where did that money come from? Borrowing. Lots and lots of borrowing, which constantly kept on piling up. By 2019, Sri Lanka's trade balance was deeply negative, with borrowings filling the gap. And so, the country's foreign exchange reserves continued to dwindle, leaving it increasingly vulnerable. Its interest repayments on borrowings too were slowly becoming a problem for its already low forex reserves. Meanwhile, things weren't looking great internally either. The government had slashed taxes in 2019. That sounds nice on paper, of course, but it ended up wiping out over $1.4 billion in revenue annually. Meanwhile, they were still spending on freebies and welfare programs. It was earning less and spending more. One bit of bad luck could knock it all out. That came soon enough with COVID-19 pandemic. What was already a bad situation turned into a full-blown crisis. Tourism, one of Sri Lanka's biggest sources of foreign currency, came to a screeching halt. With reserves already falling, the government panicked. It started looking for ways to cut down on imports of what they considered non-essential items, hoping to save some of this precious foreign currency. Chemical fertilizers made to that list. The government claimed they were shifting to the whole country towards organic farming, but really the country was just trying to cut expenses. The decision backfired spectacularly. Without chemical fertilizers, farmers couldn't grow enough crops. This led to widespread crop failure, and suddenly, Sri Lanka, a country that used to export food, didn't even have enough to feed its own people. Food prices shot up and inflation hit record levels of 50%. So the decision had to be reversed. To summarize, Sri Lanka's government was low on money, running deficits, and losing forex reserves, and in trying to save dollar by stopping fertilizer imports, they accidentally caused severe food shortages and inflation. Everything came crashing down. The government was left with no choice but to prioritize buying essentials like food and fuel over paying back its lenders. And finally, in May 2022, Sri Lanka officially defaulted on its debt for the first time in history. At this point, it had hit rock bottom. Sri Lanka had no choice but to act. The first step was to renegotiate its mountain of debt. It didn't just have one type of debt, it was a mix. Some of it was internal, owned within the country, but most of it was external, divided between bilateral loans from countries like China, India, and Japan, and international sovereign bonds. which are essentially money borrowed from global investors. It kicked off negotiations on all fronts. Bilaterally, there has been progress since. China and India agreed to restructure their loans, offering Sri Lanka more time to repay. As for the bonds, things were messy. An initial proposal was rejected by creditors, but finally, just 2 days before the presidential election, Sri Lanka managed to strike a deal. So, what's the deal? The old bonds are being swapped for three new types of bonds. First, macro linked bonds or MLBs. Second, governance linked bonds or GLBs. And step up and past due interest bonds. Here's a quick breakdown. MLBs, these bonds are tied to Sri Lanka's economic performance. If the country's economy does well, bondholders get higher payouts. If it underperforms, they get less. Second, GLBs. They are tied to governance reforms like meeting IMF targets on tax revenues. If Sri Lanka implements reforms, the government pays less. It's like a reward for good behavior. And finally, step-up bonds. These start with lower interest payments and gradually increase over time, giving the country some breathing room in the short term. These terms are more favorable for Sri Lanka, especially given its fragile state. And since the government hasn't been paying off its debt during the negotiation, its foreign exchange reserve have started to rebuild. Tourism also has picked up. Nowhere near the pre-COVID peaks, but enough to offer some support to GDP and forex levels. Inflation, it stabilized too, though prices remain painfully high. All of this means that the economy may have bottomed out. GDP growth is showing some stability, which is a relief after chaos of recent years. But here's the thing, this is just step one. There's no guarantee that it will actually turn a corner. Sri Lanka is still on life support. The debt restructuring and the breather from lenders can only take it so far. The real issues, the structural problems that we discussed earlier, still remain unsolved. Sri Lanka is still a net importer and running huge trade deficits. Its government's fiscal deficits are equally worrying, and there's no clear plan to fix either of these. Instead, we're already seeing signs of backpedaling on critical reforms. For instance, although the country had reformed its power structure, allowing private players in, its newly elected National People's Power (NPP) just reversed the reforms. Without addressing its fundamental issues, Sri Lanka risks sliding back into crisis. The debt restructuring buys time, but time isn't enough if the underlying problems remain. Structural changes are the only way forward. There's a lot of pain and hard work the country still has to get through. Moving on to the next story. The Indian government has announced measures to boost the domestic supply of diammonium phosphate, that is DAP fertilizers. This follows disruption caused by the Red Sea crisis, which hurt fertilizer imports. Since 60% of DAP is imported, these steps aim to ensure steady supply and reduce reliance on imports. But why does DAP matter? And how does this tie into the larger story of Indian agriculture? You see, fertilizers are broadly meant to add three crucial nutrients to soil: nitrogen, phosphorus, and potassium. Each fertilizer has distinct uses. For instance, DAP, which is 18% nitrogen and 46% phosphorus, is crucial for early stage crop growth. It's a staple for rabi crops like wheat and mustard. India heavily depends on imports for fertilizers, particularly potassium and phosphorus based ones, making it vulnerable to global price swings and supply issues. This is why the government is pushing for increased domestic production. But this is a hard problem to weed out. India simply isn't self-sufficient with its fertilizers. India's fertilizer story began with the Green Revolution of 1960s, when the government introduced high-yielding seeds, irrigation, and fertilizers to boost farm productivity. Since fertilizers were expensive, the government stepped in with price controls and subsidies to make them affordable for farmers. These measures were immensely successful, winning food security for India after decades of persistent food shortages. However, they also created inefficiencies over time. Today, India spends nearly 2 lakh crore annually on fertilizer subsidies, one of the highest in the world. This ensures that fertilizers are affordable for farmers, but it also causes imbalances. These subsidies are given to manufacturers instead of directly to farmers for whatever costs they incur beyond a price cap. This builds in perverse incentive. The more inefficient you are, the more subsidy you get. This discourages modernization in the industry. The cheap urea is overused by farmers, upsetting the ideal NPK ratio of 4:1 and harming soil health. Over time, this has caused considerable nitrogen pollution in the soil. The low prices of fertilizers make it attractive far beyond Indian farms. They are often diverted for industrial purposes or smuggled to neighboring countries like Nepal and Bangladesh. For example, a 50 kg bag of urea is priced at 266 rupees for farmers, while its production cost is around 3000 rupees. The government bears the difference through subsidies. This gap not only strains the exchequer but creates black market opportunities where urea is often sold at inflated prices. At the same time, entities in the sector are hit by heavy government controls. The production and distribution of fertilizers is heavily regulated. Its chemical composition is subject to government approval, preventing product differentiation. Moreover, because the subsidies create such a big fiscal burden, the government often delay payments, which puts businesses through considerable financial uncertainty. All this makes it hard for private entities to thrive in the sector. A large portion of India's fertilizer production is in the hands of PSUs. The rest of our demand is met through imports. India is world's largest fertilizer importer. While domestic production covers urea demand substantially, we are heavily reliant on imports for other fertilizers. Around 60% of India's DAP is imported from suppliers like Morocco, Jordan, and Saudi Arabia. All of our MOP is imported as well, largely from Canada, Belarus, and Russia. India's heavy reliance on imports leaves it vulnerable to global supply shocks. In 2021, for instance, China suspended all fertilizer exports, which severely hurt supply in India. The Ukraine war, meanwhile, has completely disrupted India's potash supplies. Although the government has started joint ventures and expanded domestic production, progress has been slow. These distortions lead to supply shortages, fluctuating availability, and inflated prices for farmers, further exacerbating the sector's challenges. India is stuck in a tight spot. Its agriculture sector suffers from severe economic distortions, which constantly throw up a host of challenges. At the same time, the sector is also fixed in its ways, and as the experience of the farm laws show, bringing change is hard. Until then, however, band-aid solutions are the only things on offer. Moving on to tidbits for now. First, Honda Motorcycle and Scooter India enters the EV market with the Activa E and QC1 targeting 100,000 units in the first year. Leveraging its vast network of 6,000 outlets, Honda plans to capture 50% of key EV markets, starting bookings in January 2025. Second, the US economy grew 2.8% in Q3, driven by strong consumer spending and steady corporate profits. While inflation and borrowing costs remain challenges, business investments signal confidence in the long growth. Number three, India's imports from China show an $18 billion data mismatch due to valuation differences and reporting inconsistencies. This highlights the need for stricter trade scrutiny and better regulatory practices. And finally, a record 505,000 passengers traveled domestically on November 17, driven by India's peak wedding season. Airlines are seeing 80 to 90% demand growth for November, with charter flights and international honeymoon destinations in high demand. That was it for today. I'm your host Kashish, and this was the Daily Brief. See you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.